I'll give you a proper introduction here, Phong. You should need no introduction, but for the sake of completeness, Phong has been CEO of Strategy here for 2022, excuse me, at Strategy for 10 years. Served in many roles, COO, CFO, and then 2022 taking the CEO spot from Michael Saylor, who moved to executive chairman. It's been, when I think of you guys, having worked with you over the past few years, I think of a few things. I think of innovation, I think of first to market, which are not the same thing. I think of challenging traditional thinking. It's been quite a journey as your banker and advisor to keep up. I've learned very early on that no is not an acceptable answer, which is great. It's been a wild ride. I think I'd like to start, if we could, Phong, by going back a little bit to the history. You were there. It was in August of 2020. Was this shock the market announcement that came out of MicroStrategy at the time, which was you were buying $250 million worth of Bitcoin. And if you could, kind of go back on a retrospective as to how you got to that decision, aligning stakeholders, what was the decision back then leading up to, events that we find ourselves today?
Thanks, Lee. Thanks, everyone, for joining us. I think coming out to the Hamptons on a day like this probably wasn't too hard. So fantastic, beautiful venue. Now think about the opposite of this experience, which was March of 2020, when we all learned that the NBA was going to shut down its season and the entire United States was going on lockdown. That's what it felt like in 2020. And when your back is against a wall, that's typically when people innovate and come up with new ideas and invent new things. And all of us had our backs against the wall. I'll take you back a little bit further than that. Strategy was formerly MicroStrategy. We're a $500 million revenue, about $400 million ARR software business that provides B2B enterprise software and analytics to the largest companies in the world. Michael Saylor founded it in 1989, went public in 1998, and the company in 2020 had about $1.5 billion market cap. If we were to have sold a company, we might have been able to sell it for $2-3 billion. For all intents and purposes, if I told you tomorrow you can go start a $3 billion software company as a founder, you would all say that's tremendous life success. And you can go sell it, own 20% of the equity, make whatever it is, $400 to $600 million, sit down, have fun, go on your yachts, buy a house in the Hamptons, and retire. And that's a pretty good deal for a lot of people. It wasn't for us, right? We had a great software company. That's still a great software company. But when we had $500 million of cash on our balance sheet at that point in time, saved for a rainy day, sitting in what you would say is probably the safest money, short-term treasury bills earning 2.25% in March of 2020, there was an issue, right? There was an issue because along with COVID came the U.S. government deciding and the Fed deciding to cut short-term interest rates to zero. Which I think was reasonably appropriate to stimulate the economy, and then to print about $5 trillion on a $20 trillion monetary supply. We could all argue at this point in time whether that made sense or not, but we can't argue the result was going to be rapid inflation and debasement of the U.S. dollar. Janet Yellen, in October of 2020, even argued that inflation was transitory, and I think we all know that it clearly wasn't transitory. So we sat with $500 million that was earning 2.25% to zero and was worth very rapidly 20% less than what it was in March of 2020. And so our backs were against the wall. We're a software company. We had 800 people in a thriving headquarters in Northern Virginia. We had 200,000 square feet of office space that we were paying $10 million a year for. And literally overnight, that was worth nothing. Nobody was showing up. We were all sitting at home, Zooming each other. We no longer were having lunch together, having drinks together after work. It was a pretty shitty experience. And when you're faced with that experience of your money is now worth 20% less and earning you nothing, your 800 headquarters-based employees aren't coming into work, you're a thriving software company. Our valuation started to go up in the second half of the year like a lot of tech companies did. We just said, well, what should we do with this problem? And, Mike's an inventor, risk taker. I wouldn't say I'm an inventor, I'm an operator, but I'm a risk taker. And we looked at all the options out there, and time again, lo and behold, Bitcoin seemed like the best answer to solve the problem of what to do with our cash and how to transform our treasury. And that's how it started.
That's great. And retail has obviously been a huge piece of the storyline. How do you view the difference of sort of the retail investor base versus institutions, broadly speaking, and how they've supported the story?
Yeah, the retail thing has been, I wouldn't call it a surprise in terms of their interest, but the fervor and the level of interest is just outstanding, right? Like, we will launch new equities into the market. We will publish every week in 8K, and literally we'll have brilliant, PhD level economists, financiers, engineers go on like that night and do a 2-hour podcast and try to dissect what we're doing, say it better than we would have said it, say things we can't say, and say things the banks can't even say, and publicize our equity and publicize our preferreds. And they're all making money, so they're loving it, right? And they're bringing more and more retail base. It's this virtuous cycle, similar to the virtuous cycle of Bitcoin. Right, you convince somebody that Bitcoin's good, they go buy Bitcoin, drives the price up, your equity value goes up, you are able to raise more money, you buy more Bitcoin. It's a virtuous cycle. Same thing on the retail investor base. And what's different, I would say, about, people call it meme stocks. What's different here is there's an underlying business, there's an underlying strategy around Bitcoin, and there's an underlying perfectly engineered asset called Bitcoin that this is all based on. And so the retail folks are just tremendous. The institutional folks are sometimes also, great. Some of them are fast money. They're hedging us. They're shorting us. Most of the retailers are long, right? Like triple long, quadruple long, but they're pretty long. They're levered long in a lot of cases. I wouldn't necessarily do what they're doing, but it's fantastic. And it's great to see them succeed. So success begets success in this space. And Bitcoin is it's one of those things that is, I think people follow it and really believe in it to their core, and so it even gets the retail base even more jazzed up.
So retail's been the early adopter here, and institutions have sort of a ways to go. And I think that in many ways, I want to talk about your capital structure strategy, but you're kind of teasing out that institutional investor adoption curve and kind of pushing them, right, by the creation and the framework that you put in place for your capital structure.
Yeah, the institutions, depending on the ones, in 2020, the institutions were led by people sitting in large institutions who already inherently believed in Bitcoin. And they were fighting their internal institutions, right? Whether it be like a Cap Group or a Fidelity or even a BlackRock, like investing, or Morgan Stanley and otherwise. They're getting in because there are very intelligent, and stubborn PMs who are like, Bitcoin's the thing, and I'm going to bring my institution along the way. Now we get to the point where a lot of the institutions are in it, not quite understanding Bitcoin, but understanding that you can't ignore, a 10x return or a 10x dividend on something that's 10x over collateralized. And so now we're at the point 5 years later, especially after I think the administration changed too. It's made it safer for institutions to get involved. But a lot of the institutions are in Bitcoin for the return profile. They've started to realize, how can you ignore the best performing capital asset in the last 20 years, Bitcoin? How can you ignore the best performing US equity in the last 5 years, strategy? How can you ignore the best performing global equity in the last year, Metaplanet? Like, if you're an institutional investor and your job is to provide risk, excellent, better than market risk-adjusted returns, you can't ignore this asset class anymore. And so 5 years ago, it was the Bitcoin maxi folks sitting within an institution. Now it's the institutions realizing they have to get on board because their customers want access.
There's a really interesting nuance here in that, again, given the early nature of the adoption curve for institutions and protocols that are in place that just don't support direct holdings of Bitcoin, uniquely, you're a stock. And you're in the index. I mean, maybe you talk about the evolution where you got picked up by the indices and passive holders now, and just think about the momentum that's behind your name because you're an equity ticker.
Yeah, before the beginning of 2024, the only way a lot of these institutions who could buy equities could buy maybe some ETFs, but they couldn't buy commodities, and they certainly couldn't buy Bitcoin. They couldn't open, folks at Fidelity weren't exactly opening up like Coinbase accounts to go buy Bitcoin and put it into cold storage, right? So they needed access. And so before 2024, we've been publicly traded for 25 years. And in addition, we're a well-known seasoned issuer, WIXI. And we have a management team that's been running public companies for that same period of time. I've been the CFO since 2015. We were the safest way to onboard to Bitcoin, essentially as a publicly traded Bitcoin proxy. What changed in 2014 was the advent of Bitcoin ETPs, BlackRock's IBIT's the largest. But those, you're basically getting access to the price action of Bitcoin. And you're paying whatever it is, 30, 50, 100 basis points, depending on the ETP, but you're not getting leverage, right? And you're not getting the upside of somebody being able to take out a convertible note, somebody being able to issue prefers, issue secured debt, levering up their company to buy more Bitcoin. And as a result, producing one of our KPIs is Bitcoin yield. An ETP creates zero Bitcoin yield, zero Bitcoin gain. You just get direct access to Bitcoin price action, which is, by the way, not so bad either. Those who own Bitcoin, you can do it easily through an ETP structure. But we went from being, 1-to-1 Bitcoin exposure in a publicly traded vehicle to 1.52x the performance of Bitcoin through leverage. And so those were changes that created innovation. And our last innovation that really began at the beginning of this year is, how do we provide people access to Bitcoin in a non-dilutive way? And that's what our preferreds have been doing, right? We launched 3 so far. We announced the launch of another one yesterday. And so that's what our preferreds do. And so it's been a staggering of strategies that we put in place that have kept us ahead of the market. But it's also giving investors, institutional, retail, what they want.
So when you look at sort of the balance between your debt and equity, your capital structure framework, is it based on leverage targets in terms of optimal leverage and sort of that return on Bitcoin that you're targeting? Do the securities provide access to different pools of capital? Like, what are the key attributes when you think about filling out, what instrument might you issue next, and what instruments are in your capital structure? Last year you did a lot of converts. This year is the year of pref. So, goals in that capital structure framework and how investors can play.
Yeah, so I guess there's a supply and a demand side to the equation that dictates what do we issue into the market. On the demand side, we talked about people who wanted exposure to Bitcoin, and that was sort of the sort of Bitcoin 101, MSTR, buying Bitcoin, people buy MSTR, right? Bitcoin 102 is then how do you leverage up? And how do you leverage up early in our existence was primarily through convertible bonds, which the issue with a convertible bond market's great, right? But the issue is, number one, institutional only, right? 144A listed. And so it's not like a retail investor can't access convertible bonds. If you start to spend a lot of time in the market, which we did, we were the largest issuer of convertible bonds of anybody in the year 2024. You start to meet these folks, and maybe some of you are here, very smart, guys, but there's like 30 of you that trade convertible bonds in the US and dominate the entire market. 30 people trading convertible bonds is, by definition, a reasonably inefficient market. And so the credit spreads that we pay, the premium that we pay to the market in convertible bonds is pretty large. In addition, the holy grail of convertible bond investors are the long investors, right? You want to go find somebody who's going to buy your convertible bond and hold it for 5 years. The reality is they represent a small fraction. 90% of the convertible bond market are people who buy it and they turn around and they short you the next day, actually the same day, right? And so it's a nice access to a pool of capital on the demand side, but it's inefficient, and as a result, it's reflected in the pricing. And so we said, all right, we largely tapped out the convertible bond market. What's the next piece? Well, who else there? How do we get to retail investors? The way you get to retail investors is through a 4-letter ticker listed on exchange, right? And so that's part of our requirement, and preferreds fit that requirement, right? The other way you get to retail investors is you give them a return profile that's superior to what they can get out there, right? And so we started with a convertible preferred and then traditional preferred. If you go look at the preferred market, it's dominated by banks in the US that are giving people 400, 500, 600 basis points in yield, depending on who the counterparty is. Morgan Stanley can go issue a preferred, which they do almost every quarter, and they'll give you 450 basis points in yield, and your counterparty is Morgan Stanley. A Greek bank will issue a preferred into the European market and give you 1,000 basis points of yield, and your counterparty is not Morgan Stanley, it's a Greek bank, which I would argue is more risky than Bitcoin, right? And so we said, well, what if we can give that level of yield, 1,000 basis points, 10%, with Bitcoin backing it? And so that had a level of interest, and we've seen things like Strife, which we issued in the market in the second quarter, appreciate 50%, 40, 45%. And so that's the next pool of capital. And then really, when you start thinking about it, who do you really want to get out to? You want to get out to retail investors who are looking for yield, who are yield starved, right? And so that's the final piece of the demand that we work on is, somebody who is a high net worth individual who's 70 years old. Maybe it describes, a lot of the people that live here in the Hamptons, right, who are looking for a monthly or a quarterly dividend to pay off their living expenses, right? And so that's a huge pool of capital, right? There's a lot of money, hundreds of trillions of dollars in that pool that we want to be able to access, and we're giving to that market something that they can't get otherwise, right? I think there's about $15 trillion in U.S., $30 trillion in a combination of U.S. checking accounts, savings accounts, and money markets. And you probably all have one of those, and maybe you're able to get 4% returns on your money market. Someone who probably has lower net worth might be able to get 0.5%, 50 basis points. And wouldn't you want to be able to get 800, 900, 1,000 basis points on that? So that's sort of the last piece of pool of capital that we're trying to access with these preferreds. And we're able to do that because it's all backed by Bitcoin. Now, on the question of what is the right leverage profile, it's ultimately a question of what is, the metrics we look at, Bitcoin yield, Bitcoin gain, and now Bitcoin torque, will help determine what the right leverage profile we have is. And we think through that. We used to think 20 to 30% was the right profile. We're not even quite there yet. I think we're closer to like 10%, depending on the price of Bitcoin. So there's more leverage to be had. And then the question is, how long, what is the risk profile? What is the growth rate of Bitcoin? What's the volatility of Bitcoin? And how long can we sustain that for? And our goal is to have an appropriate amount of leverage that gets us to, at some point, being an investment grade company, right? And so we're not trying to lever up on high risk securities and debt. We really want to get into a place where the securities and the debt we have are low risk.
So you transformed the preferred market from the sleepy REITs and banks and really created a whole new market opportunity, which is commendable. One of the big shoes to drop are rating agencies, and actually to have them catch up to, either recognizing Bitcoin as collateral, or you mentioned investment grade, once that happens, I mean, there's a potential unlock in the institutional market of an unbelievable amount of capital, right?
Yeah, I'll start with, I appreciate you noticing that we transformed the CP preferred market. We couldn't have done it without Barclays, by the way. I still remember it was beginning of last year, 2024, we had dinner and I was sitting down with Lee and Tad and a bunch of folks from the team, and I said, we're going to do this with or without you. And the fact that Barclays said, hey, we want to be part of this, we want to be leading this with you, meant a lot. You were a little scared along the way, but hopefully you thought it was worthwhile.
It's been worth the ride.
And look, you know, one of the lessons of all of this is we're not trying to buck the existing banking system or financial system or government system in the US or in the world. You have access, you have thought leadership, and within your firms, you have people who are really intelligent and are risk takers. So it sometimes looks like we did this ourselves, but clearly having partners like Barclays and some of our other banking partners were huge. Because I think sometimes, and I know maybe this is against a lot of people's thoughts when they think about digital assets, people want to be anti-banking system, anti-government, anti-country. And I think the way we've done it and the way Bitcoin should be done is with the banking system, with the government, with the country. And now we're in a place where I think the government has created a regulatory scenario that can actually all work well together. But you actually had a question that I didn't answer.
Well, it was about the rating agencies in particular, because I do think that's a major unlock for you in terms of the potential. I mean, the performance on the prefers has been commendable, right? And it just shows you the supply, you know, too little supply, too great demand. But if you on top of that, unleash the rating agencies and actually bring them to the party, the demand side is, I mean,
just like the banking system, government regulators, the SEC, FASB, the OCC, the CFTC, are necessary and can be additive parts of the process. So can ratings agencies, right? And just like the banking system and just like the government, there's a process they need to go through. And so we're working with them, like, you know, all the major agencies we're talking to and working to on getting rated, step one. And then maybe a step two is getting the appropriate rating, because they all need to figure out what credit do they give for the Bitcoin on our balance sheet. You all probably think we should get, you know, credit for the Bitcoin on our balance sheet like cash. I think so too. They're not going to think that way day one, right? Maybe not even day 2 or day 30. But they're a necessary part of the process. And yeah, the big unlock is large insurance companies, pension funds, endowments, you know, huge money managers are in some cases only able to buy securities that are rated, and in some cases investment grade. So where I talked about the demand side of Bitcoin and capital and MSTR and our preferreds, that's another big unlock, is if we can access those types of pools of capital, right? The global bond market is about $300 trillion, right? And you know, I don't know the exact number, but I would guess at least half of that is locked up with money managers who are only able to purchase something that is rated, and a smaller but still large portion of that are full of money managers who could only purchase something or hold something if it's investment grade. And so that would be the next step.
All right, I mean, until we have a couple more minutes.
I think we're a bigger version of what we are now, which is a Bitcoin treasury company, a digital capital transformation company, and we offer Bitcoin-based capital across every sort of asset class and every stack of capital in the world. And we're just getting started, right? Like there's, you know, 2040 is not that far away. I have a son who just turned 20, and we're like, didn't we just have him? Like 20 years is not long in our lives. So 15 years isn't long. And if we're at the point where every single investor, every single investment manager, every single portfolio manager, every single high net worth individual, every single retiree, every single banking, checking account, savings account, money market can instantly access Bitcoin-backed securities in 2040. It would be a great thing. It would be a fantastic thing. Think about a world where we have tokenization and literally somebody in Botswana can buy MSTR or can buy one of our preferreds or can buy another Bitcoin-backed security like on a Sunday at 12 p.m. Right? That's the world that we want to get to. Or think about a world where, you know, sometimes you move money, you go onto your bank account, you know, whatever it is, Citibank, Bank of America, Wells Fargo, and you're like, hey, you know, I'm going to transfer some money from my checking account to my money market account because I want to get my 4.5% yield on that for a month, and then I want to put it back in my checking account. Now imagine if you could do that to an account that provides Bitcoin-backed yield of 9% instantaneously any day of the week. That's the world we need to get to. And so I think there's a ton of work to do between now and 2040 to get there. Hopefully we get there sooner rather than later. I think the banks, I think the regulators, the U.S. government, et cetera, we're all going to get there. You're all going to get there. You're going to create the technology to get us there. We will create the securities to get us there. And I think if you had asked us 5 years ago if we would have progressed this far now, I would have said no. And so, you know, let's see what happens in 14 years. But I probably think 5 years at a time max. And, you know, I think 5 years from now, we'll be having another fantastic conversation about the progress of Bitcoin and the progress of strategy.
Great. Well, I want to thank Phong for his time and partnership, and everyone enjoy the rest of the day.